Hello, everyone. My name is Dan Lear. I am a financial planner and partner here at Affiance Financial, and I have the pleasure to welcome you to our 2023 virtual market forecast presentation. This is my first time moderating, and after a tough 2022, I desperately hope to be your good luck charm in 2023. If you are interested in taking notes during the event or having a copy of the slides, they are available to download in the chat feature. We have enabled closed captioning. However, you are able to disable it. We will be recording this presentation and we'll be emailing it out after this event. Please feel free to share with others in your life who might have an interest in the same material. I will now send this over to our Chief Investment Officer and the head of our investment committee, Marc Usem. Take it away, Marc.
Thanks, Dan. Thanks for the introduction and welcome everybody to our 2023 market forecast presentation. It's a pleasure to be with you tonight, and we appreciate your being here. Before we begin, I'd like to read our disclaimer that we must read. So please remember, there can be no assurance that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful due to various factors, including changing conditions and/or applicable laws. The content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as the receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. With that, I'd like to share one of our favorite first slides that we've had in a long time. This is a headline from just a few days ago. On the same day, we saw two stories. One said, "Stock buyers beware," with a big red screen and a bear. And the other said, "Ignore the doomsdayers. Things are looking bright for the bulls." And you can see the nice bulls there on Wall Street. So which one is it? Clearly, there's always a divergence of opinion. Tonight, we will try to give you ours. First, our predictions disclaimer. Forecasts create the mirage that the future is knowable. Peter Bernstein said this. We will try to tell you what we think is next. We approach this whole process with a lot of humility, knowing the future is unknown, but we will do our best to give you our opinion of what we think based on the data that we have today. So what's our agenda tonight? We'll take a look back at 2022. We'll look at where we are now as of January, end of January here, 2023, and then what do we expect in 2023 and beyond? We will try to discern, is the glass half full or half empty? Before we jump in, I'd like to introduce some of our team. Tanner Steele and Ryan Smith work closely with me in the investments and trading areas. They are huge supports and provide extensive help on research for all of our investment work. We also have an investment committee, which meets once a month. All of us are on the committee, including our founders, Steve Lear and Andy Fishman, Dan Lear, who is hosting with us tonight, and our president, Eric Unger. I'd like to thank, by the way, before we jump in, Marcia and Keely as well for all their help in putting this presentation together and in putting our whole presentation for tonight in place. Thank you so much. So what were our 2022 predictions? Well, we said Fed action is justified. The economy does not need continued stimulus. Well, that was true. The Fed acted. The economy didn't need stimulus. In fact, it needed the opposite. We said inflation is largely self-correcting in time and the Fed will not need to move too far. Well, that was true and maybe false. Clearly, the Fed didn't agree, and time is a relative issue in terms of, yeah, maybe in time it's self-correcting, but not in real time. So the Fed clearly had to move last year. So let's just say that was wrong. We said the stock market will gyrate with strong but more normal earnings growth, about 10%, offset by valuation headwinds in the near term. Okay, right and wrong. Clearly, significant valuation headwinds. The market did gyrate, but earnings growth was not normal. It was flat to down just a bit. We said stock market investors will be rewarded over the next decade, but we expect lower average returns than the past decade. Well, that's hard to know after just a year. We'll see. Bonds will earn their coupon at best. Yeah, I guess that was pretty right. Bonds had their worst year ever. So maybe too optimistic and too hedged as of last year. And then higher interest rates, higher mortgage, auto loan, and other lending rates. Clearly that was accurate. Interest rates moved much higher last year. So all in all, we were probably, I think, more right than wrong. So let's look back at last year and what actually happened. So I think the highlight clearly is that it was the worst year in history for bonds. Bond index lost 13% last year. Long-term treasuries, the worst year ever, down 31%. It was a terrible year for bonds. Stocks had a bad year too. The S&P was down 18%. Growth stocks, more highly valued, down 29%. And value stocks down only 8%. Big difference between growth and value last year. Flipped from what it was in 2021. International markets also down about 14% and emerging down 20%. So across the board, across the world, stocks and bonds down. Cryptocurrencies had their worst year in history. Now they don't have a long history, but nonetheless down 65%. And of course, highlight there was FTX and what happened with the fraud in the cryptocurrency area, Sam Bankman-Fried, and clearly the headlines are well known. I would just say that crypto is a place that we had not believed was an investable space. We're still very, very skeptical about cryptocurrencies. You can see they may have a place, but we don't think it's in your portfolio. Commodities, positive. It's the one green light last year. Energy up 64%, fantastic year for energy. Corn and soybeans and most other softs were up 25%. Gold was flat. So commodities were the bright spot in 2022. Let's dial back and look at stocks and bonds last year and just what an outsized decline we saw. 2022, the worst year for combined stocks and bonds since 1931. And the scatter plot shows how far out, what an outlier this is out here in 2022 with the red dot. 1931 was a little bit worse, and mostly due to the fact that stocks were down more that year. Bonds pretty similar. Bonds are generally positive, even in down years for stocks. And we can see that even in years that bonds were down, their declines are pretty modest of maybe just a couple percent. So really, really an outlier last year. Looking at years when stocks are down, how do bonds usually do? Like we said, usually good. And this just shows that again. The blue lines going down are the years stocks were down. The orange lines going up. Again, paired almost perfectly, except for 1969 and 2022 last year. And you can see what a bad year that was. So again, really rare for stocks and bonds both to be down in a year. So what happened to bonds? What happened to bonds last year? Well, interest rates went up and they went up fast. So bond prices and interest rates move inversely with each other, largely because, or really because, bonds are just a series of cash flows that are discounted back to the future. And as that discount rate or interest rate goes up, the current value of those future cash flows goes down. So that's the relationship. That's why they move inversely. And the speed at which rates rise is really critical because it doesn't allow bonds to reset. So for example, in a portfolio of bonds, maybe you have some shorter and longer term bonds, and if rates go up really quickly, they all get hit. Whereas if they go up slowly over time, you actually get to roll the lower coupon rates out and higher coupon rates come in. That didn't happen last year. Bonds went up. Bonds went down quickly because rates rose so quickly. So again, rates started the year very low, 1.5%, and shot all the way up, ending the year at 4.25 in October, and ending the year back a little bit lower toward 3.5. So how do we get here? Well, it's really part of the pandemic fallout. So COVID-19 pandemic hit. We had monetary stimulus, that's the Federal Reserve cutting rates at that time from about 1.75 to 0.25%. QE stands for quantitative easing. They were starting to buy treasuries and mortgage securities at a rate of about $120 billion a month to keep rates down and markets liquid. At the same time, the federal government stepped in with 3 large stimulus plans, over $5 trillion in stimulus, including checks that went out to just about everybody. That actually worked. It was the shortest recession in history, only 2 months long, but had a side effect called inflation. We just saw the highest inflation in 40 years last June when it peaked at just over 9%. Let's take a little deeper dive into inflation. Here we'll look at the CPI, or Consumer Price Index, and core CPI, which excludes the more volatile food and energy components. They move pretty much together. And if we look back in history, we can see it. You have to go all the way back to the 1980s to see anything like the inflation that we saw in the past year. Now, inflation's come off a bit. It's about 6.5% as of December. But the Fed's target is still much lower, 2 or 3%. Now, historically, at times when inflation has spiked, it has often coincided with recessions. We don't know yet what 2023 will bring. We'll talk more about that in a few minutes. Digging more into the Consumer Price Index, what happened last year? Well, oil demand, which had stopped due to COVID and then surged after the reopening, really was affected by the war in Ukraine. And you can see the energy jump in the CPI was significant. Chip shortages impacted used car prices and drove used car sales. Supply chain disruptions hindered the supply of nearly all goods. Housing prices jumped on remote work options. People could work anywhere. And low mortgage rates that made housing very affordable. And then food prices increased due to the war in Ukraine and some really special situations like bird flu. Housing is actually the largest component of CPI at about 33%. And we usually works with the lag, in large part because rents are usually, or leases are usually about a year, and it takes a year for them to roll off. And so we probably don't know the full impact of housing on the CPI for about a year. But last year, 2022, we were seeing the impact of actually 2021's housing market, but we are seeing the impacts of that fuel and energy services market on the CPI, which is again really significant. A little aside of the egg price thing. So everybody goes to the grocery store. People kind of know the prices of certain things, particularly filling up your tank with gas and buying things like eggs. Egg prices went up almost 3 times last year, but it had nothing to do with COVID. It had nothing to do with the other inflation issues. It had nothing to do with the war in Ukraine. It actually mostly had to do with the fact that there was a bird flu, the worst avian flu in history. Of the 400 million laying hens, about 53 million have died, over 13% of the flock. And that's what really drove egg prices higher. So yes, egg prices went up tremendously. It's not a large dollar number, but it's a huge percentage number. So what's happening now? Well, the Fed's fighting inflation, right? There's 2 sides to this story. The Fed side impacts demand. They influence that by increasing interest rates, quantitative tightening, and the money supply. In essence, they control the price of money. Then there's the supply side impacts. Supply chains, specific shortages, China's COVID-based disruptions, and government subsidies, all which influence the supply side. Oftentimes people will talk about one side or the other, forgetting that there's really 2 sides to the story. So why do we have to fight inflation? Well, I thought this quote from Jay Powell was really great. He said, "Without price stability, the economy doesn't work for anyone. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. Couldn't say it better than that. So what did they do? Well, the Fed's moving historically fast to tame inflation. This is a chart of the federal funds rate, the interest rates they control. And we can see 2022 is the most rapid increase in interest rates in history. If we look at a little longer history of the federal funds rate, we can go back to the end of the dot-com bust, 2002. Fed lowered interest rates, and you can think of the Fed funds rate as a little bit like a accelerator and a brake on a car. As they lower interest rates, they're pressing the accelerator. As they're raising interest rates, they're pressing the brake to slow the economy. Works pretty well over time. After the great financial crisis, though, they kept rates at 0 for over 6 years because the economy grew so weakly, and then started to raise it. We ran into COVID. They took rates back to 0. And now we can see just in the last year, raised rates 7 times from 0 all the way up to 4.5%. They have a meeting coming up in a few days, next Wednesday, where we expect they'll raise rates once again. The other tool the Fed has is their balance sheet. They can do what's called quantitative easing or quantitative tightening, adding money to their balance sheet or selling things or letting them roll off their balance sheet. Since COVID, the Fed actually increased their balance sheet by over $5 trillion. This stimulus, if you will, meant they bought over $5 trillion worth of treasuries and mortgage-backed securities. Really a significant amount, especially if you look back to the great financial crisis where $1 trillion or so was added. And then as they added to the balance sheet back in 2015-16, the stealth recession, very small, both relative to what happened during COVID. They have started quantitative tightening along with raising interest rates, meaning they're allowing bonds to roll off their balance sheet, which in theory should reverse this process, leaving rates on the margin a little bit higher and reducing some of that liquidity in the fixed income markets. So is it working? Well, we think so. Inflation pressures are moderating. Let's look at the supply chain side first. Things are moving. So cargo ready date to destination port goes from 120 days. This is going from the US to Asia and back. From 120 days at the peak here at the end of December. And it has really improved during the last year. We're down to 70 days. Not quite back to where it was pre-pandemic, but significant improvement. Another data point is looking at container ships waiting off the Los Angeles and Long Beach ports. I don't know if everybody saw some of the pictures of hundreds of ships literally anchored off the port waiting to dock and unload goods. And you can see the significant improvement from 2021 where it spiked up to over 100 to now it's down way below 10. So things are really moving well on the ocean. That's great news from the supply chain perspective. Now, let's shift to the housing market for a minute. New home sales have been down every month for the past 11 months. Again, this has about a 12-month lagged impact on CPI and the Consumer Price Index. But higher mortgage rates going from about 3% a year ago to 6+% today, I think they peaked at just over 7, have significantly impacted the housing market and home sales. That's a big multiplier. So when people buy homes, they fill them up with stuff, right? So it's not just the home, but you got to get furniture and you get new things. And that's a big multiplier for the economy. That having almost really stopped the real estate market with mortgage rates doubling is a significant headwind to consumer spending and inflation. Finally, if we look at the car market, I think that was headline news a year ago. It was really hard to get cars. It still probably is versus what it's been historically. But you can see, again, prices of new and used cars are moderating from the highs of last year. So good news on the inflation front. If we shift to oil, again, we knew energy was one of the biggest factors in CPI last year. Russian oil exports to China, India, and Turkey have leveled off. So China, India, and Turkey together really sopped up that demand, that excess demand that got cut off when Russia stopped shipping oil to Europe. So really the Asian markets picked up most of that excess demand, although not quite all of it. At the same time, the US in particular has been pumping more oil. So US oil production has been increasing, albeit somewhat more slowly than in the past. I think many energy companies have been burned historically by the boom bust cycle in that market, and they've been a little more reluctant to bring capacity online. But they are increasing it, and that will help keep oil prices down. Let's look at oil prices specifically here. If we look back, we can see COVID, when things just crashed, the markets shut down across the world, markets reopened, and oil prices spiked. And then again, once the war in Ukraine broke out, up to this about $120 a barrel price. Excuse me, and then oil prices have moderated significantly since then. I think one of the interesting things to think about in the oil markets is not just the price of oil and how it affects filling up our gas tanks, but also just how pervasive it is throughout the entire economy. Almost everything we touch has some impact from oil. About 60% is in the form of fuel, about 40% can be found in everything from mascara to medical devices. Everything that gets shipped to you, every Amazon delivery, packaging, all these things are touched by the price of oil. So it is a really significant impact to the economy broadly defined. We do want to focus on the employment markets for a second too, and just note that there's a lot of talk about inflation and unemployment. There is some connection, but it's really weak. So here we are in June of 2022, and we are at a very low rate of unemployment, about 3.5%. That being said, at the same level of unemployment, or very close to the same level of unemployment, we could have inflation at 2%. This has certainly happened many times in the past. Inflation doesn't have to require a significant change in unemployment rates. Now, we expect there will be some change, but again, it's not a requirement to have lower inflation. So let's summarize. Inflation's moderating. COVID-19 monetary and fiscal stimulus drove artificially high demand. Supply chain and related perfect storm issues drove supply shortages, such as we saw in eggs. Ukraine, nobody could have forecast what was going to happen there. So many things happened that weren't part of just the normal COVID-19 issues, so to speak, and inflation resulted. The Fed's fighting inflation with higher interest rates and quantitative tightening. Demand is being reduced, especially in interest rate sensitive sectors like housing and autos. And supply-related inflation impacts are also moderating. We saw the supply chains are starting to work again. So headline inflation is responding, both to the supply and demand sides. So again, we can see fiscal and monetary stimulus impacting and supply chains impacting inflation. And we think it's really working. And the question is, how long will this go on? How long will the Fed have to continue to raise rates before we get some relief? Well, it's a really good question. I think it's the Fed's quandary, if you will. It's not the data, it's credibility. So the Fed really misjudged inflation in 2021. They were late to take action, calling inflation transitory up until November of 2021. So they were wrong. Then they admit that, actually. They are still making up for mistakes of the post-Great Financial Crisis zero interest rate policy we saw on the chart. Those 6 years where they kept rates at almost zero, that probably was a mistake. And so the question is, will a recession be required to restore the Fed's credibility? They really have to build that trust now that they're not going to balk when inflation starts to ebb and start cutting rates too early. Let's take a look at GDP, gross domestic product, and what that looked like historically in last year. I think the COVID pandemic clearly is something that's just extraordinary. Never seen anything like this in history. And I think to a large extent, we could ignore this data, hopefully forever. But let's just look at last year. First 2 quarters of last year were slightly negative, meaning the economy slowed just a little bit. Then in the second and third quarters, the economy grew 3.2% in the third quarter and 2.9% in the fourth quarter. So the economy is actually still pretty strong coming out of 2022. But we are seeing some headwinds. So retail sales were down in November and December, modestly. So generally you would see these numbers up on a sequential basis, but they showed some weakness in retail sales. That's one of the biggest drivers of consumer demand. Reflection of consumer demand is retail sales. And it was really across all industries in November and December. A little bit of a precursor of what might be to come. Let's look at the consumer savings rate and consumer debt. Clearly, again, COVID distorted things significantly. Economy shut down, people had nowhere to spend, and they saved a lot of money. Highest in history, 33.8%. At the same time, there was nowhere to spend, they paid down debt, some of that money. So consumer debt services is this red line. It bounced around as we had different stimulus packages. And then since sort of early 2021, we saw the savings rate continue to edge down below where it was now prior to COVID to about 2.5%, while consumer debt service payments continued to increase, probably a little bit above where it was prior to COVID. This is not sustainable, right? So if we are using our savings and leveraging ourselves to maintain our standard of living, the question is the consumer really tapped out now? Is consumer demand going to slow? Now, just to back up for a second, consumer demand or consumer spending is the highest or biggest part of gross domestic product that drives our economy. It's about 70%. So the consumer is critical. Let's shift to the industry side. Manufacturing Purchasing Managers Indexes for goods and services. This is an index that shows, is the economy expanding in goods and services or contracting? The 50 level here is the level above which things are expanding and below which things are contracting. And we have just crossed that 50 number here at the end of 2022. During COVID, of course, it cratered quickly and then bounced back. But historically, these numbers coincide with lows in equity markets. So just having crossed the 50 line, our expectation is that economy is slowing, the Fed's work is taking effect, and these numbers will probably continue lower. Another reflection of economic activity, weekly economic index, this is higher frequency data, shows a very steady decline since the COVID bust, and then boom, economy reopening, and things have steadily started to get weaker. Another indicator of economic health is the 10-year Treasury bond minus the 2-year Treasury bond rate. These are comparisons of longer rates and shorter rates. When shorter rates are higher than longer rates, it's called a yield curve inversion. A normal yield curve slopes upward with longer term maturity bonds having a higher coupon than shorter ones. And that is flipped today because the Fed has raised short-term rates so much. When this has happened in the past, it's usually a fair amount of time before a recession, and it does tend to precede all recessions. We can see back in the 1990s, 2000, 2006, between 2006 before 2008. Briefly here before COVID, really didn't really get much below zero, but flat, and now significantly inverted. There is a long lag. They are not coincident. You can see that as well, meaning just because the yield curve has gone negative doesn't mean there's going to be a recession tomorrow. It could be a while before the effects are felt in the economy more broadly. So what's the bright side? Employment. The unemployment market is still tight. We're at 3.5%, having spiked to 14.8 after COVID. Again, a number hopefully we'll never see again, back to 3.5%, with economies really really showing that we need workers, right? Let's look at that specifically. Job openings versus the unemployment level. Now it flipped at the end of 2019 going into 2020. And then again, significant gap here between the number of job openings and people looking for jobs. So this is actually a really interesting situation that's rare historically. And I think the strong jobs market does imply that couple of things. One, it emboldens the Fed, means that they can continue to raise rates without disrupting employment markets too significantly, and may soften the impact of an economic slowdown. So what do market returns look like during a recession? Well, the data is pretty mixed. The last few recessions, we've seen markets down, but historically there's been periods where markets have been able to rise during recessions. That didn't mean they didn't go down for part of that time period, but it means that they can perform even during recessionary periods. I think the thing to expect is some volatility. In this market, we think bonds look pretty attractive. Here are the headlines. They're slowing economic growth. We saw GDP, but we expect that to slow going into 2023 as the Fed keeps rates high. And there's that lag between the time interest rates move higher, the Fed starts to tighten, and the economy actually reflects that. And we're getting close to about a year from when things started back in March of 2022. We know inflation's falling. That's a positive. We think longer term interest rates will be stable or could fall a little bit as the economy slows. Coupon rates have clearly been set much higher, right? 1-year treasury bills yielding over 4.5%. And we're coming off the worst year in history for bonds. Usually that means that the next year is going to be very good, although it always has been in the past. Of course, there's not too many cases. And then bond yields exceed the S&P 500 dividend yield. S&P 500 dividend yield is still under 2% with the 1-year treasury bill at 4.7. So we think bonds look pretty attractive today relative to recent history for sure. Let's pause and take a closer look at stocks. First is valuation. S&P 500 price to earnings ratio. So that's the price of the S&P index divided by the S&P 500 earnings estimate for the year. And the peak was over 31 back in 2021 and has dropped significantly down to 18 now based on forward earnings expectations. Now, earnings didn't change much from 2021 to 2022, meaning that most of this or all of this decline is really due to a compression in the PE ratio. What multiple of that earnings people are willing to pay for stocks doesn't really reflect a significant change in earnings itself. So we can see earnings is now well below the historic highs, much more attractive relative to where it was. Let's look at earnings per share going back in history a little bit. There are times when earnings per share have fallen. 2020 was COVID, of course. 2021, earnings shot up from $122 to $208. We think 2022 was about 200, so flat to down just a little bit. And the big question is, what is 2023 going to look like? Right now, market consensus is about $225 a share, significant increase, about 13%. We think this is not terribly likely given what's happening in the macroeconomic environment, that earnings would rise significantly as we approach what likely will be a recession sometime in 2023. A 20% decline, which is not unusual, would leave earnings at $168. Now that may be overly pessimistic. It may not go down that much, but to think that it's up significantly this year seems to be unrealistic. This is a busy chart. There's a lot going on, so let me try to decode it a little bit. We look back at S&P 500 earnings, which is the red line, and the S&P 500 index level, which is the blue. And they track each other pretty closely over time, right? which how it really should be. The peaks in the prior markets have been in the 20s, high 20s. .com PE was 28. Financial crisis, 2007 PE was 23. Pre-COVID PE got up to 26. So one of the questions is, where are we now? Is the PE back at 22 where it was based on earnings expectations, or is it really 17 based on this much higher number for 2023 earnings? And I think this is really what we have to discern today. The dotted line is the trend line for earnings. And in all the prior times that earnings have fell, we've seen it come through the trend line. And we can see the amounts that have declined from peak to trough. So 32% back here in the 2000s, great financial crisis 57, pre-COVID 22. A 20% decline would bring it to $168, this gray line right through the trend line. Again, the market expectation, $224, meaning it never got through trend and just continues higher. Again, we think it's probably optimistic. Whether it gets this low, probably not, but maybe somewhere closer toward trend. So what's the question here? How is 2023 going to end up? Is it going to be better than 2022? That's really what we want to try to figure out, right? Well, we know historically, after a bad year, the next year tends to be good. It's rare for there to be consecutive down years. And in fact, in over half the years that the market's been down, the next year the market's up 20% or more. We can see there's only a few occasions from 1950 where markets actually were down more than a year in a row. Worst being the .com bust, where market was down actually 3 years in a row, unprecedented in history. So we think 2023 could be an up year, even with down earnings, if the recession maybe is mild or weaker, and then the economy has a chance to recover toward the end of the year. Now, a fun fact we want to throw in, because statistically extremely interesting, is we are in the sweet spot of the presidential cycle. This 7-month transition from year 2 to year 3, from October 1st of year 2 to April 30th of year 3, of course, we're in January here. This is a time when markets have actually performed extremely well historically. Statistically, 1 in a million chance that this is just, random. And in fact, a very significant increase versus all the other times. And consistent, right? This has happened in multiple 45-year spans up to, we'll see what this year looks like. But anyway, this period that we're in right now through April, historically, a very strong period for markets. We know market timing, however, is dangerous. So missing even a few of the market's best days can significantly hurt returns. And this is just one illustration of what can happen. Missing just the best 10 days can reduce your returns by 44%. Usually those 10 best days often come after bad or the worst days. So those are the days where we want to give up and say, we're not going to do this anymore. Those are usually the days that you shouldn't do that. Missing 20 days almost cuts returns in half. Market timing is extremely difficult. And even though we try to do our best to look forward and see what we think might happen, we know that staying invested, staying with your plan remains critical. So stocks look better than they did last year. PE valuations have been reduced by more than 40%. The largest S&P stocks are down significantly, much more than the index. Inflation is falling. Longer-term interest rates look likely to remain stable or fall. We're coming off a really bad year for stocks. So those things kind of are in our favor, if you will. There is still this recession risk out there, in that we think there are still earnings reductions ahead that are not fully priced into stock prices yet. The other factor is that the Purchasing Managers Index, we don't think is at its lows yet. So there could be some more volatility before we find some stability in stocks. So what are our economic predictions? Given all this data, all these numbers, what do we think? Well, we think the Fed funds rate will increase to between 5 and 6%, or 4.5%. So we're not far from that. but we think it's more likely toward the 5% range than the 6% range, and that the Fed gets rates up to that level and keeps them there potentially a little longer than they would otherwise to make sure inflation moderates. We do think inflation will continue to moderate. We think Fed policy will be based on that inflation progress. And they know they're looking ahead. They know they need to look ahead. And it's not the inflation numbers that are being posted today, but what are going to be posted in 6 and 12 months. We think that we probably will have a recession in the next 12 months. And whether it's a deep recession, probably not, given that stability in the employment market in particular, but probably some level of recession nonetheless. S&P 500 earnings growth expectations, we think, will continue to fall still. That could be a weight on the market. And that markets are going to remain volatile, at least in the first half of the year. That strong employment market and China reopening may dampen further economic deterioration. And then the outlook for stocks is really predicated on Fed policy. When the Fed decides to pause, when they say their outlook has changed, that will be a time, I think, for getting more constructive on stocks. So what are the wild cards? And there are several. What are the extent of the Fed rate increases? This is important. Will they be able to stop at 5% and wait and see how things go? Or will they just keep marching higher up to that 6% range? The speed at which inflation moderates. Now it's coming down, and historically, we saw it. It goes up pretty rapidly and can come down pretty rapidly. If that's the case, we think that's better. So we'll be watching the speed at which inflation moderates. The depth and duration of any recession. Again, we think it probably will be muted by China and the employment markets, buoying economic growth globally, but that may or may not happen. Let's hope it does, and that it's a mild recession at best. The debt ceiling debate and the potential impact on markets, that's coming up this summer. Follow-up from the war in Ukraine, especially in Europe. I think Europe kind of escaped a little bit this winter with warmer weather in Europe, and they got their energy market in place largely due to exports from around the world that helped fill up their supplies before winter came. But for that to continue for multiple years is definitely a huge strain on Europe. China's upcoming reopening and inflation risk. So China's reopening as we speak. We've seen some positive results from that, particularly people coming for the new year into China. But it does pose the same inflation risk in coming months as it did here. The extent of fraud in the crypto markets, we saw certainly one company, FTX, go down with over 30 billion. There have been some other smaller bankruptcies, but hopefully that's contained and that doesn't have some contagion with more failures in that space. And then the unknown unknowns, which there are many. So let's highlight one. Disruptive technologies. So I don't know how many of you have seen ChatGPT or heard about this, but it's fairly new. It was really released in November of last year, so just a few months old. And this is a new artificial intelligence technology. It's called a chatbot. It's built on OpenAI's GPT-3 language, and it can write prose, poetry, and it can generate computer code on command. This is an incredible technology. You can sign up for it. I think it's still free right now. You can go to ChatGPT, get an account, and see what it does. But Microsoft invested $10 billion recently. So this is something. Google called it a code red event, meaning this is a big deal. Google needs to figure out what they're going to do with this because it's exploded. Schools and colleges are being forced to adjust for high-tech cheating. This can write papers. This can write essays. I mean, it is incredible. And this is the kind of technology that nobody saw coming, really, at least in the mainstream world here. And these are the kinds of things that can pop up and be game changers in terms of what's happening in technology and driving economic growth around the world. So really cool. The unknown unknowns, I think, is what we want to call this. And this is one of them that just popped up. So what are our recommendations? Do not try to time the market. Nobody can do it accurately. Stick with your financial plan. Stress test is needed. That just means if you think returns might be higher, inflation might be higher or lower, we can help you with that. Call us and we're happy to stress test your financial plan. Maintain a disciplined investment approach. Our motto is we are not bullish, we are not bearish, we are process. We have made changes to portfolios based on market conditions. We will continue to do that based on what we expect. This is not market timing. We'll never go in or out of the market, go to cash and wait on the sidelines. That is too dangerous, as we've shown just a minute ago. We can't control the markets, but we can control our own actions. You can rely on us for providing a disciplined approach to investment strategy, investment process, and holistic financial planning. With that, I'd just like to mention we have a new investment process handout, 2 pages. It's hard to read here, but it goes through some detail on the processes that we use in our investment management department to manage money for us, for our clients. I encourage you to take a look at this, and it may be available, I think, now in the chat box. So feel free to take a look at that. With that, I want to thank everybody for listening. Thank you for your support. Thank you for being our clients. And Dan, I'll welcome you back with some questions.
All right. So we're going to try to do an Affiance Financial first here and get you guys out of here within an hour. I'm not sure we've done that before, but we do have a few questions here. Number one, we got a lot of people asking this question, Mark. Can Congress impact the market by threatening or refusing to raise the debt ceiling? What might happen if the U.S. does default on its loans?
Good question, Dan. Certainly one that's been in the headlines recently. This is a difficult question to answer because the short answer is yes, the Congress can influence what happens in markets by the actions they take. The other answer is hopefully no, meaning that they will raise the debt ceiling. They will come to an agreement. But we know that the debt ceiling has been raised, I think, over 72 times during the years. The last time that got to the brink was in August of 2011. And there was some disruption to the equity markets at that time, although bonds didn't respond that significantly. We think a default would be catastrophic, actually, and that the impact on bond markets and stock markets throughout the world would be significant. We believe Congress knows that. Janet Yellen at the Treasury has made that crystal clear, but she does have emergency measures at her disposal. We hit the debt ceiling on January 19th. The thinking is that they can go through probably June or July with what they call extraordinary measures, but that Congress will need to come together and figure something out. The Biden administration saw what happened in 2011, and really they've been adamant about not negotiating. We know that's probably not going to last. At some point, they will have to come to the table and come to some kind of an agreement. It probably will go to the last hour based on what we know is happening in Washington today. I hope that's not the case, but it may be the case. At the end of the day, I expect that they will come to an agreement.
Wonderful. Thank you. And this next question, I hope that answers some of your questions around the debt ceiling. Next question, someone did their research on history here. Mark, it's a simple, short question. Can the market start to recover while interest rates continue to rise?
Yeah, good question too. I think the short answer there is yes. So we've had many periods in history when the Fed is raising rates and markets can continue to rise during those periods. I think the bigger question maybe goes to the old adage that, don't fight the Fed. And that means that when the Fed's raising rates, generally you want to be more conservative with stock investing, and that when they're lowering rates, you want to be more aggressive. That being said, there's been periods that the Fed has raised rates over longer periods of time and stocks have actually appreciated. I think, again, looking forward is maybe more important than the contemporaneous aspect of stocks gaining while the Fed's raising rates, which is to look forward to what might be the aftermath of Fed raising rates, which potentially is a recession. And again, we saw the data there, which is mixed, right? Stocks can sometimes perform well in recessions and sometimes not. So it really depends a lot on what the expectations are going forward at that time. So short answer, yes. Longer answer, we'll have to see.
Wonderful. All right. Well, thank you. We are going to get you out of here a little bit early. I want to thank everybody for coming to our 2023 market forecast presentation. If you have any follow-up questions specifically about your plan, please don't hesitate to reach out to your advisor. We are more than happy to talk through any of your thoughts or questions. This recording of this presentation will be emailed out and will be available on our blog as well. I hope you have a great evening and a great week. Thanks so much, everybody.
Thanks, Dan.